Ladies and gentlemen, good evening. It is the 26th of July, 2017. Thank you for being with me this evening. Let's look at what is happening in gold and silver. It has been 2 weeks since our last update. Gold is on the verge of a major breakout once again. Will it be able to do it this time? That is the key question that we will be looking at here in this broadcast. Let us look at the recent price action in gold and silver. There was a Fed meeting today. There was no change in the interest rate policy as we have been expecting at this meeting. There was some language indicating that the Fed will hold off for the time being and look to implement the balance sheet normalization that they have indicated they will be doing starting this year. They may hold off on that for another couple of months. So this was interpreted by the market as negative for the dollar and positive for precious metals here over the short run at least, because if the Fed is pushing back at any point here, the timeline for the reduction in liquidity, that would mean that they are going to keep printing more fiat money here even over the short run. So we'll look for more language coming out of the Fed at the next meeting in September as to the implementation of their normalization policy. We do see the increase here in the price of gold. It has risen higher than I expected it to over the short run, absolutely. But let's put this into perspective and we will look at the price of silver here again. Silver also continuing to remain strong. It has risen higher than I expected it to a few weeks ago. But again, when I say these things, this is always my assessment at a point in time, and I always want you to remember that I'm never short. Whenever I say that I'm shorting or that I am having a negative outlook at a certain time, I maintain significant holdings of physical silver, and I am still invested in some of the silver miners. So when I go short, I'm always shorting with a portion of my portfolio only. I do think over the long run, the more significant gains to come are going to happen to the upside. So I never want to be without a position altogether. So let us put this into perspective here. Once again, the most important thing that's happening right now, if you are new to this channel or to understanding how we are looking at things here, I wanted to do a big picture update for you. This is the price of gold out of the crash of 2008, the lows around $700 an ounce, looking at the strong rise that was seen over the next 2.5 years, almost a tripling in value up to $1,900 per ounce. And this has been the bear market that we are talking about here. We've been navigating here for the last 1.5 years on this channel. I did start this channel in 2015 because I sensed that this market was getting ready for a turn, and we are attempting to navigate this turn now. So if you're new to this, I just want to do a little update as to what everything means here on these charts. Of course, we are focused on the charts here. There are a number of other channels that are providing fundamental analysis on the precious metals, and that's wonderful to understand. I do understand the fundamentals as well. The problem is that when people are referring to the fundamentals, if you go back and listen to some of what people were saying, for example, in 2011, 2012, 2013, 2014, as to debasement of the currency, as to debasement of the monetary system, inflation, bailouts, et cetera, this was all true during this entire decline here that we have seen over the last 5 years. So the point is that when people are mentioning one or two fundamentals and saying, therefore, the price of gold is going to do the following, you should be very, very skeptical of people who are saying those things, because the unfortunate truth is that the market can simply move in the opposite direction for many, many years, despite what the fundamentals would seem to indicate. And these are real losses that many people have taken over these years. So if you want to only focus on the fundamentals, you can do so, and especially if you have a real long-term time horizon here. However, the point of this channel is to actually look at what is happening in the market and what the higher probability outcomes are based on the trends that we can plainly observe. So for example, these magenta color lines here, we are referring to the long-term downtrend that formed from the 2011 high. Nothing random about this. Look at the hit right here at 1900, the hit at 1800 here a year later. Big, swooping, diving downtrend that then formed a lesser channel. You can see this here by the turquoise color lines. And notice the breakout of this turquoise channel here, the parallel channel. Okay, and then on that breakout, it seems that this market has taken a new set of trajectories here. So whereas there was a grinding decline, we noticed something of some stability coming into this market. Now, where were the rallies halted in 2016? We were covering this last year, but on no less than 1, 2, 3, 4, and there were a few mini hits on this exact same downtrend line here dating back all the way from 2011. Multiple hits there, a failure. Now look at where the low for the failure actually came in here, right at a retest of this broken parallel channel. So that was a very interesting data point there that we had at that point. Two significant lows a year apart. You thus have a new rising trend forming over the intermediate term. The coming together of a rising trend and a major long-term downtrend brings us into the triangle formation that we are navigating now. Over the short run here, once again, another hit on this long-term downtrend. The figure that I'm watching right now is right around 1265. So it's very, very close once again. But I do want to caution that we have seen this game many times in the past here, especially around these Fed meetings. We've seen these attempts to break out and then negations. We saw that on the Trump reversal, the Trump victory reversal here last November. So we are once again seeing another hit on this long-term downtrend. Now, what is going to happen? Let me bring out my crystal ball here. And it says, no, I'm just joking. Of course, I do not have a crystal ball. What I do have here is a system that helps us to assess probabilities. And the system does help me to understand the trends that are in play. We look at a lot of leading signals here. One of those leading signals that we've been focusing on a lot is, and we are going to zoom into this most recent part of gold's consolidation. Of course, let us remember this is happening amidst an attempt to break out of this long-term downtrend. Let's zoom this in. And now the price of gold is on the bottom. So this is one of those leading indicators. We're looking at the price of gold on the bottom. This is using the GLD fund. This is a paper fund. And on the top, exact same time scale, we are looking at the gold mining sector, represented by the GDX fund. And we're looking at those peaks that we've seen here over the last 6 months, right? This first peak, second peak that went up to 1295, the third peak, the false breakout at 1297, it came back down, and then this attempt once again. And we're just drawing a simple line here from the current price here, gold right around 1260, all the way back, and we're saying, okay, this 1260 price correlated very nicely with the peak here in the metals back in February. What have we seen over this corresponding set of peaks in the gold miners is a very clear set of declining peaks. The GDX is nowhere near where it was at the related set of February peaks in the gold market. So this is one of those leading indicators that is giving us a negative signal still at this point. Okay, we look at a lot of other things at various moments. We look at the Japanese yen versus the US dollar. We look at the US dollar itself. We look at the commodities. We look at what's happening with the stock market ratio to the mining sector ratio, et cetera, et cetera. This one signal here, though, still is giving us a warning at this point. Now, the GDX came right back up and is testing this downtrend today. So we will see what happens here over the remainder of this week. Absolutely is going to be very important, especially the close on Friday. A GDX close above 23 on Friday would be a significant reversal signal in my mind. However, taken as a sum, we still have to say the GDX is causing a reason for concern that gold may not be ready to break that downtrend quite yet. Now, have the miners ever underperformed at the beginning of a bull market? In other words, could this signal, the leading indicator from the miners, could this signal be giving us a fake signal, basically? And the miners are just underperforming for, whatever reason. Maybe they just don't believe it and they're just wrong. In my experience, I would say 4 out of 5 times when we look at this ratio, the miners have it correct. So we see a number of examples of this throughout history, including that 2011 long-term peak was foreshadowed about a year ahead of time by the miners failing to match the gains in the price of gold itself. About 4 to 5 times, that is what we will see. However, no signal is perfect, and I did want to bring up this example for you to show you. And this is why I have not recommended nor have I closed all of my mining positions, because I know that in the beginning of a suspected bull market, it is quite possible that we could just be getting one of those rare false signals here. So let's look at this. We're going back to the 2003 through 2006 time period here. And we are looking once again at this is a different index because the GDX does not go back to 2003. This is the HUI Gold Miners Index. This is a more pure index of gold miners only, approximately 20 gold miners. And here is the price of gold. So we're going all the way back in history when gold was $300 an ounce, let's say, in the middle of 2003, mid 300s. And take a look at some of the signals that we were getting here from the HUI Gold Miners Index. For example, let's compare this peak here in the HUI in November of 2003. And let's compare that with the peak that came a couple of months later here, right at the beginning of 2004 in gold. For reference, this was a gold price of $420 per ounce. So we're going back 13 years. And notice how the price of gold made a new high the next year at $460 an ounce, shown here by the green arrow. And notice how the HUI made a lower low than the 2003 level. Let's look at another example here. The low that the HUI made in 2004 on this decline in the metal, the low here was hit exactly about a year later at this 165 level on the HUI. But notice the related low in the price of gold never came all the way back down to that level. So as a sum here, we saw the gold miners basically lagging in their peaks and making lows that were not matched by the price of gold. And what was the result? The result in this case, this is the one exception that I have found, the one significant exception. We're talking here a multi-year time frame. The one significant exception where we see the result of this is that gold was actually right. And gold shot up here from $420 an ounce in 2005, almost seeing a 50% rise over the next 6 months. In percentage terms, a 50% rise from $1260 where we are today would be over a $600 rise in 6 months. So that would be like gold going back to $1,800 an ounce by next February. And of course, then the miners followed, and the miners leveraged that gain. The miners basically went up 100% over these 6 months in this 50% gain in gold. The point here is that the miners were basically wrong during this period. So what is the point here? We have to bring back the main chart. We have to focus on the gold chart. This is the most important thing. The point here is to say gold is once again making an attempt to break out of this major long-term downtrend. When it does so successfully, this will not be a small move. This is going to be a significant move. I'm predicting something like this, at least as an initial move, and I'd say this is probably going to happen before 2019. Probably sometime within the next 6 to 12 months, we will see something like a $300 rise for starters in the price of gold when this downtrend is broken legitimately. So it's going to be a big initial move coming from this. We still have the negative leading indicators coming from the gold miners, but the point of this video is to show you that once in a while the gold miners will simply get it wrong. So we are following these signals very closely on a weekly basis. I do release a premium research service that comes out at least once per week, if not with flash updates in between. Just to let you know, we are now doing premium members only videos. They are in this similar format, but more in depth. And we're looking at basically every leading signal that we have whenever there's a relevant signal. We also cover the GDX, individual miners, basically the exact trades and investments here that we are using to manage the in-house portfolio. I also do individual consultations by voice and by email if you require an independent researched perspective on your situation. So this is going to be an exciting time to watch this, whether it's now or whether gold takes a dip here as the miners are indicating. I'll be watching for some support coming around 1180 if gold fails at this juncture. And then it'll be gearing up again for another attempt, possibly in the fourth quarter. So let's watch very closely the close this week, and let's stay nimble. And I do thank you for joining me. I will see you this time next week.